the way, one of the announcements you can see on the slide there is a reminder that if you haven't already, please complete the course evaluations. I count on that as pretty important feedback to know how to make changes to the course, and a lot of things that you're doing now are a result of student suggestions that I've had over the years. Just for instance, putting my lectures on YouTube, that's directly from a student suggestion that I got probably about 8 years ago now. Previous to that, I was putting them on some internal Marshall server, and they were a lot less easy to get to, and they weren't streamable over a variety of devices, and so that's why I switched to YouTube, is because of a student suggestion. And likewise with the in-class exercises, how I have one of those for each of the class meetings. It used to be that I only had them for about a third or maybe half of the class meetings, but students consistently told me that they found those to be pretty useful, and so I made the change. So please, if you have suggestions of your own ways that I can improve the class or things that you think I shouldn't change, just any feedback at all, feel free to get into course eval to do that. And I have pretty thick skin at this point. I've been teaching college for 15 years, and so sometimes students get a little worked up and negative, and that's okay. I can handle it. But just if you've got ideas, I'd love to hear them. So are there any questions or
There's no question. I'll tell you one of the things that I did for the feedback. Like, I know a lot of the stuff we got into was real dependent on Excel because it was just so much calculation. It was easier to do through Excel. But at times I found it difficult where I use Excel so often to go back and do it manually or with my hand.
Yeah.
And I don't know if there's a way that you could show more hand calculations through those sections, so where we could at least take notes, but that was like the only thing that I found that I had difficulty with.
So you're saying, for example, when we did a technique both by hand and by Excel, once we started using Excel so much, then you forgot how to do it the hand way?
Yes.
Okay. Yeah.
And I'm not sure how you can adjust that. I don't, maybe it's a me issue, but that was one thing that I put down.
Yeah. Well, there are a handful
of... But other than that, I thought Go ahead.
No, please, you.
I mean, other than that, like, that was the only thing that I had to say for a suggestion, because I thought the course was laid out great, and the way you've done it has been really well with the video lectures and the slides as well. So
I appreciate it. I'll definitely have to go back through and see, there are certain things that we only do by Excel, like external rate of return. We wouldn't dream of doing that by hand. But then there are a handful of things, there are certain things that we do both ways, and so I appreciate that suggestion that maybe practice the old-fashioned method would help you, because then sometimes on the test I ask you to do it the old-fashioned way. So thank you. If you have other observations like that, please feel free to include them in that course eval. It really helps me out a lot. Okay, so the way that you get to that, it's through MyMU. So once you go to MyMU and log in, then the menu on the left side of the screen, the student tab, student resources, and then course eval. Now our final exam is on Tuesday the 8th of December, so you've got a little bit less than a week to prepare for that. And in Friday's class, and maybe if we have some time at the end of today's class, I'll just flip back through the course schedule. I think of the course schedule is probably the best way for you to review what we've covered and when. And sometimes students ask, how can I prepare for the exam? Should I watch all the lectures again? And I don't think that that's probably the best approach. My suggestion is to look through each of the in-class exercises, and if you could do that again, then that's great. And if there's one that you don't feel so confident about, then maybe try and repeat that in-class exercise and look at your notes or the Excel file that you've saved, and of course the solutions and the Excel calculations are also recorded in the lectures, and so you can be a little bit more selective in how you prepare for the test. And of course reworking homework problems is another good way to prepare. But the exam will be comprehensive, but there's going to be added emphasis on the material that has come since our second midterm exam. And so topics like price, demand, and break-even, inflation, payback analysis, cost estimation, all of those topics have come since your last midterm and you haven't yet been tested on those. And so proportionally more of the points will be from that material, and then there will also be some of the points coming from the older stuff. All right, so you've still got about a week to prepare for the final. That's going to be posted on Blackboard at 10:15. You'll have 2 hours to take the test, scan it, and then upload it again, along with any Excel file that you use. Today we're going to continue talking about depreciation, and just to get you in the mood for preparing to study for the final, I wanted to remind you that a big part of the points on the exams are concept questions. And I'd have to say that probably concept questions is where students struggle the most. I think there are a lot of people who feel like they can do the calculations fine, but then they sometimes struggle to explain the underlying concepts behind a method. And so let's go through just a couple of softball questions related to our lecture from Monday. So first of all, depreciation. Anybody willing to chime in either in the text area or unmute the microphone and explain what is depreciation? If you had a short answer question, how would you explain that to somebody who hadn't heard of it before?
I mean, to me, it's the amount of money that decreases over time from use of a product, say like a vehicle.
Yep. So, very good. Yeah, and I see lots of good comments in the chat area there. The decrease of value of property over time, your stuff loses value over time things lose value, and that's all right. The sentiment is correct. So now, what about this? How is book value different from market value? Now, we've talked about market value a lot this semester, but only recently introduced the idea of book value. So what's the difference there?
Book value is what you say, like the Kelly Blue Book rates what the car is worth.
Okay.
Market value is what somebody is willing to pay you for that vehicle or for the object that you're selling.
Okay.
So if the demand is high, you may actually get well more than what the book value is on a vehicle or a baseball card.
Good. Yeah, that's right, Craig. And KC mentioned a similar thing in the text area, that book value is what it's worth officially, market value is what the market is willing to pay. So book value, the way that we calculate it when we're doing depreciation calculations is it's the initial basis, so that's the starting price. It's what you paid to buy the item and get it in service. So basis minus depreciation. So book value, in a way, is just an accounting fiction. It is, according to the book, which is the accounting estimation of how much remaining depreciation can be taken from that item. Because book value doesn't necessarily coincide with how much people are willing to pay for it. And what a company is hoping is that the company wants the book value to go down as fast as possible, and the company wants the market value to go down as slow as possible, because the market value represents the actual value of the item in terms of its usefulness and its resale. But the book value is just simply related to getting, well, I don't want to spoil that because I think it's related to one of these next questions, but I think you probably get the idea. So here's that next question that I didn't want to spoil. Why do companies like depreciation? And that's not to say that they like the actual decline in the value of their things, but Harry says taxes. Can you elaborate what you mean? They don't like taxes, so why do they like depreciation? Reduces taxes, yeah. So they can use it to decrease the tax they pay. Now it's important that you understand exactly how it reduces the tax they pay. It's not a tax credit, as KC has suggested. There's a very fine distinction between a tax credit and a tax deduction. So a credit is a dollar in credit reduces the tax that you owe by $1. But $1 of deduction is going to reduce the tax you owe by less than $1, because all it's doing is it's saying this dollar doesn't get taxed. all the other dollars beyond that do get taxed. And so let me put it another way. I think I gave the example, Jonathan saying anything they don't sell loses value, so they don't need to pay as much taxes if they don't sell everything. Well, remember, you can't take depreciation on inventory. And so depreciation applies to your capital equipment, but not to the things that you're making and want to sell for other people. So companies like depreciation because it reduces their taxable income, and therefore it reduces their taxes. And so if you have your equipment loses $1,000 worth of value, and your company made $3,000 worth of profit this year, then you'd only get taxed on the remaining $2,000. So your profit minus depreciation is then going to be the leftover amount, the profit minus depreciation, that is going to be your taxable income. And so it reduces how much of your income is subject to tax. All right, last question. We talked about two methods in class on Monday: declining balance and straight line. And so this is, I'm glad I asked the question this way, because sometimes students make the mistake of, in a question like this, they would simply define the two things. And so that would be an incorrect answer. If you said straight line depreciation is X, and you define what it is, and then you say declining balance depreciation is Y, and you left it at that, if all you did was define those two terms, then you didn't answer the question. Because the question is asking, how are the two different? So this is like kind of a compare and contrast type question. And so, they both are methods for estimating how equipment is losing its value over time, but in what way are they different? Is what I'm asking.
Straight line, you take a set amount each year.
Okay, good.
For the life of the equipment, and declining balance, you may lose more in the first few years, but as it goes further, you lose less for the life of the equipment.
Okay, good. So you're right. Craig said that straight line is when a constant amount, meaning a constant dollar amount, is depreciated each year. And declining balance is where a fixed percentage is being deducted each year. So every year the item loses 20% of its value from the previous year. And so that means in the first year, it's 20% of the initial purchase price. And so that's going to be a big amount. But then in the next year, it's 20% of not the initial purchase price, but it's 20% of last year's value. And so each successive year, the depreciation in dollar terms is getting smaller. So then how are they different? The difference is the way that the depreciation quantity is calculated, either as a fixed dollar amount or a fixed percentage. So be sure and look carefully at these questions when it's asking for, if two different things are mentioned and it asks how are they similar or how are they different. Don't leave it at just defining the two things, but try and find in what way they are different or similar, or just be sure that you address all points of the question. All right, so remember that concept questions generally on exams account for about 30% of the points. So even if you can do all of the calculations perfectly, and then you bomb the concept questions, if you don't understand the concepts, then you're only going to get maybe at best a C grade. And the reason for that is that you may over time lose the ability to do certain methods perfectly. In 5 years you probably won't be able to sit down and just immediately bang out an external rate of return analysis. You probably have to refresh your memory on that. But what you may remember, and what's important, the thing that persists and that you retain the knowledge, is the concepts, because once you understand the concepts, then you can figure out the particulars later on and you can refresh yourself on the technique. But that's why I insist on including some concept questions on the exam, because the person who understands the concepts really is going to be able to solve the more sophisticated problems, and their knowledge is going to be more durable than somebody who doesn't understand the concepts. All right, well, let's talk about The modified accelerated cost recovery system. This is the third method of depreciation that we'll be talking about. The first being straight line, the second being declining balance. But MACRS is kind of, it's not the dummy way of calculating depreciation, but it takes a lot of the guesswork out of it, that's for sure. Some of the foundational principles is that it always goes to zero value, and so the company is allowed to depreciate the entirety of the equipment's initial purchase price. It assumes that nothing has remaining salvage value. So companies like it for that reason. And it also accelerates when the depreciation occurs. So it starts with double declining balance. So that means it starts at a 200% declining balance, and then it switches to straight line. And the reason why it has to switch is that in the declining balance depreciation, you never actually get to zero. You only get, well, remember, it's a fixed percentage every year. So if you have 25% depreciation each year, then the first year is 25% of the initial purchase price, then the next year is 25% of the previous year. So each year it's just a smaller and smaller and smaller depreciation amount. So if you just only have declining balance, then it never goes to zero value. And they wanted to set up a system that had the advantages of front-loaded depreciation, but then also depreciation to zero. And so that's why it has to switch from declining balance to straight line. Categories are assigned to different equipment types, and there's a standardized useful life. Irregardless of the manufacturer of the item, it's just set by category. And so a bus will have a standard recovery period, whether it's made by Bluebird or whoever else makes buses. Same thing with computers. It doesn't matter if it's a Lenovo computer or an Acer computer, just computer equipment is all deducted over a certain number of years. And we'll look at some of those category definitions and the number of years in their recovery periods in just a moment. Now, the HalfLife Convention I just mentioned briefly in Monday's class, and the way it works is that it assumes that it doesn't matter when you buy the item in a year, but during that first year that you own the item, you only get a half share of depreciation in the first year. And that's to de-incentivize people from buying an item at the end of the year and trying to get a full year's worth of depreciation out of it. I think I talked about that loophole in Monday's class, where it would be possible to buy an item on the 31st of December and then get a full year's worth of depreciation, even though you only owned the item for one day. And so the half-year convention just means that the first year you own the item, that you only get half of what would normally be assumed for the depreciation amount. And that's built into the tables. That's not something that you'll have to remember. It's just I'll point out on the table where we see that half-year convention. Now here are those categories that I was mentioning. And so for instance, a bus. It is assumed with, now we're talking about MACRS, also known as the General Depreciation System, so we'll use this column GDS. Even though sometimes items have a longer class life, they're allowed to depreciate over a shorter number of years. And so you'll notice that in most cases, the GDS is less than the class life, which is understood to be how long it maybe would last in a real world situation on average. So a bus, for instance, although a bus is assumed that in reality it might have a useful life of 9 years, the depreciation is calculated according to GDS over a 5-year time horizon. And so if we look at some of the different types of things here, construction equipment, 5-year depreciation timeline, petroleum refining equipment, 10. And so we just have to know what is the item that's being depreciated and then pick up the recovery period. And once you know the number of years, then you'd go to a table like this, and it tells you what fraction of the cost basis is depreciated in each year. And so let's talk about, for example, mining equipment, 7 years. And so if we had some mining equipment, then we wanted to know how much depreciation does it get each year. We'd go to the 7-year column, and what you can see is that in the first year, it's going to lose 14.29% of its value. In the second year, 24.49%. And then it starts declining from there. And so the half-year convention is such that even though it's a 7-year recovery period, you'll notice it actually happens over 8 years. So it's such a funny misnomer. But what they've done is they've split some of the depreciation that should be in the first year, and they've pushed it down. So you assume that you're owning the item only half of the first year, and then the half share of depreciation that otherwise would have been lumped in the first year is shifted downward and cascades so that we have a depreciation amount in year 8 as well. So Lim, you'll notice, yes, it goes up just because the first year is assuming you only own it for 6 months, and so half a year of depreciation, and then it declines from that. So that's the half-year convention. So you actually, all you have to do is multiply the initial cost basis by these fractions, and it tells you how much depreciation there is every year. The method itself is pretty simple. Now,
One question, if I may. Yes, if I may. It's basically based on how, like when you buy a brand new car, you know the rule, when you drive it off the lot, it drops $3,000 to $4,000 immediately in what the value is. Why does that happen? Is that based on something, or is it overpriced? I've never understood why when you pull it off that you lose that much money.
Yeah, well, I can only speculate, but here's what I'd suspect is that, dealers are notorious for adding on a bunch of fees like the delivery charge and an advertising fee and prep charges, and so probably all of those add-ons that the dealer is sneaking in for the first person who buys the car. The second person who buys the car is only willing to pay for the car itself, and the second person who buys the car isn't willing to subsidize the dealer profits and sneaky fees.
Okay.
So that's
that
my
makes
speculation. And remember that what we're talking about there in the case of a car is the market value. That isn't necessarily driving it off the lot. It actually has a book value depreciation, but it's just the market value. And I think that one of the ways that they're trying to push back against that is if you look at certified pre-owned cars, they're not that much cheaper than buying a new car. So dealers are trying to kind of reinforce the idea that no, your car doesn't immediately lose value as soon as you drive it off the lot, because they are, in some cases, I remember a few years ago I had a friend who bought a pre-owned car because the pre-owned car had a better warranty than the new car did. That was just an incentive that the dealer had put together to try and subsidize and increase the perceived value of a used car. But I take your point that there definitely is an effect where there's a lot of depreciation. I told you that I was previously thinking about the Porsche Panamera. Well, I'm thinking a little bit more reasonably now, and there's a Volkswagen called the CC, and I've been looking at that lately. And the Volkswagen CC, when you buy it new, like the 2017 model was in the mid 30,000, but you can get it now only 3 years later for like in the mid 15,000. So it just has a shocking amount of depreciation up front, going from 35 to 15 just over the space of 3 years. So
I actually bought the 2015 truck, 3/4 ton heavy duty crew cab. It was booked for almost 50,000, and I paid 17 for it when I bought it.
Yeah.
A year later.
Wow. That's huge. Yeah. Okay, so the way that you calculate the depreciation amount in any year is you just use that factor. So lowercase d, these are those factors. And so it's the percentage depreciation that occurs in a given year, and you multiply it by the original book value. And so then therefore, the book value at any year is the initial purchase cost minus the cumulative depreciation. So this is really easy to set up either manually or in Excel, where we can have each row represent a given year, and we're calculating the book value and watching it decline over time because of these depreciation factors. And so let's do that very thing. Let's take a look at some, let's see, a bus. Your company spent $238,000 to buy a bus in 2018. Yeah, I guess this slide's a little bit old because 2018 isn't this year anymore. In any case, let's use the table to find out, first of all, what is the recovery period that should apply, and then what is the depreciation amount and the book value amount for each year. So starting with its initial purchase price, then let's calculate how much depreciation was there in that year and what will be the ending book value after that depreciation amount occurs. So start Excel, and I'm going to set up kind of a template. If you don't have an idea of how to start, I'll begin putting it in Excel, and then we'll go through the solution together after you've had some time to work on this one. Okay, so what you should do is have a book value, a starting book value of $238,000. And what we want to find out is what is the book value at the end of each year. And what we know here is when we're doing this depreciation system, it should end at 0. So there's going to be no salvage value. But what you need to do is use these factor percentages, and we're using a 5-year recovery period, and so you'll have these go in as the lowercase d, and then calculate the depreciation amount as the function of the initial book value. And so there won't be any depreciation in year 0. It will be in the first year that there's depreciation. You'll notice that this table starts at year 1. And so the book value starts at $238,000. We want to find out how does the book value go down over time. And if everything works out correctly, it should terminate at 0. Okay, I'm going to start working through this one. You can follow along if you're stumped. Otherwise, you can continue working. Okay, so let's take a look at what we've got here. The bus has a category of 5-year recovery period, and so we're going to use this column, the 5-year recovery period, and you'll notice it has 6 rows, but that's because you only get a half share of depreciation in the first year. So it starts, remember the way it works is it starts at double declining balance and then it transitions over to straight line. And that's why the last couple of years are a constant amount, is because it's straight line, but then the last year, year 6, is only half of a straight line amount. And so in each of these, at least the ones that last long enough, there is, I don't think I showed the entire 20 year. Let me go back to, maybe I didn't hear either. Yeah, I truncated that. Here's the full table. Okay, so you'll notice that it becomes constant for some of these, where the amount is the same because it's straight line, but then the final year is only half a year. And so that's why, for example, a 20-year recovery period actually has 21 rows, because you're getting a half year of depreciation in year 1 and then a half year of depreciation in year 21. So in this case of the homework, the in-class exercise that we're working, then I just copied over the factors, and it should be in decimal form, not as a percentage. That's why I changed what I called it here, the depreciation fraction. And then you multiply that fraction by the original book value. So I've anchored the reference up here to the book value. So then as I drag it down, it's looking at the new row's depreciation factor, but always here at the original book value. And then the depreciation is cumulative. And the easiest way to do that is to have the new book value be the previous year's book value minus the depreciation amount for this year. And then since none of that is anchored, as I drag the formula down, it always looks at the next cell above and then the cell to the left. And so that means that the depreciation amount will be cumulative, and as hoped and expected, the book value drops down to 0. All right. All right. So that's it for depreciation. I got a request at the beginning of class if we could spend some time going over a homework problem. So let's take a few minutes to do that.